Welcome back. I'm Kirill Talai, investment analyst with a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Two stories today. First, the US jobs report came out on Friday. It came in hot, and a strong labor market usually supposed to be good news, but the market sold off on it. We'll talk about why. Second, that job report triggered a pretty sharp correction. The Nasdaq and the whole AI trade had their worst day in over a year. I'll make the case that this is a healthy correction rather than a top. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
The jobs report first. I'll keep this part tight because it is really the setup for the bigger story. The US economy added 172,000 jobs in May, against an expectation of about 80,000. So more than double what was forecast. And it beat every single economist survey. The unemployment rate held steady at 4.3%, and wages were up 3.4% of the year. On the headline, there is a strong, healthy labor market. Now, where did those jobs actually come from? Because that matters. The gains were concentrated in three places: leisure and hospitality, local government, and healthcare. And a big part of that leisure and hospitality number is most likely the World Cup. North America is hosting it this summer. The United States is one of the three host countries alongside Canada and Mexico. And the tournament kicks off right now. So you get a wave of hiring around hotels, restaurants, venues, and travel. Now, the point is this. This is a good report, the third or fourth strong in a row. But seasonal hiring, government, and healthcare do not necessarily add up to a robust, broad-based labor market growth. So here's what the market did with that. Coming into Friday, investors were already questioning the Fed's ability to look through inflation, with the oil and Hormuz situation still unresolved. A strong jobs report, in the market's view, means the Fed has no reason to cut rates and every reason to stay focused on fighting inflation. So rates spiked, although not to the levels we saw in late May. And that jump in rates is what set off the leverage unwind in the extremely crowded AI trade. And by the way, this is not only a US story. The same thing is happening in Europe, where the market has moved to price somewhere between 2 and 3 ECB hikes this year. But that part is not really about the jobs report. European officials have been signaling hikes for a while, so Europe repriced well before Friday. What changed last week is that the US caught up with the market, starting to price the Fed in the same hawkish direction. So that was the trigger. A hot number, an inflation scare, and rates were pricing higher. But a jobs report on its own does not take the Nasdaq down 4% in a day. To understand why it hit so hard, you have to look at how the market was positioned going in. That is the real reason. So, on Friday, the Nasdaq and the whole AI trade had their worst day in 14 months. The last time the Nasdaq fell more than 4% in a single session was the trade war sell-off back in April 2025. But I think this time it was a healthy correction. It was a positioning flush in the most crowded, most stretched part of the market. And the look underneath the surface tells you it was a reset, not the top. Okay, so how stretched things were? Three things had stacked up. One, the S&P 500 had risen 9 weeks in a row, its longest streak since 2023. The market had gone almost straight up with no pause. Two, retail had piled into call options. The leverage had been building fast in specific corners of the market over the past few weeks. And 3, the market had become incredibly narrow. There is a measure called implied correlation, which simply tells you how much stocks are moving together. Going into Friday, it was sitting at the record low, down in the bottom 1% of its entire history. Here's what it means in plain terms. The market had stopped moving as one. A handful of AI names were ripping higher on leverage, while the rest of the market sat still. This is the textbook definition of a narrow, stretched market where the whole index is carried by a few names. So, not a healthy setup. So, what happened? The Nasdaq 100 fell 4.2%. Nvidia alone fell 6%. And across the cheap names, you had something like $1 trillion of market value wiped out in a single day. The broad S&P 500 was down 2.6%. The mechanics are exactly what you would expect from that narrow setup. When the market deconcentrated gets a shock, all that build-up leverage gets blown out at once, and the stocks that had been moving on their own suddenly move together and down. That is what a crowded trade unwinding looks like. And this is the key point. The jobs report did not cause this. The market was a pile of dry leverage sitting in the sun, and the hot jobs print was simply the match. If it had not been the jobs numbers, it would have been something else. Now, why do I call this healthy rather than the start of something worse? Because of what happened underneath the surface on the same day. On the worst day for tech in over a year, every single defensive sector of the market closed green. Utilities, consumer staples, healthcare, financials, all up. So the money that came out of the crowded AI names did not leave the market. It rotated into everything else, into the parts that had been ignored for months. That is a rotation, not the start of the bear market. And I did some analysis of past situations like this. When you get this exact combination, the whole volatility complex spiking while defensive sectors hold up. The market has been higher a month later about 88% of the time, up roughly 3.5% and up around 6.5% 3 months out. By one strict measure, Friday was the single biggest rotation day in 19 years. We had another volatile session on Tuesday, but the market clawed most of it back by the close. So the base case after a day like this is constructive. And I do think this is a constructive setup more than a worrying one. Here's the other side, because I'm not telling you to buy it back with both hands. Last episode, I said I would be cautious on the market around the SpaceX IPO and into the summer. And I still think that is right. There are a lot of potential triggers of the next couple of weeks. We get the CPI inflation report, which lands right after I record this. Then we have a run of central bank meetings where the focus will be on how they read inflation. The Fed meeting is the big one because it is the first under Kevin Warsh as chair, and how he talks about inflation matters a great deal for how the second half of the year plays out. On top of that, the supply of stock is getting heavier. Last episode, we talked about the wave of AI IPOs coming. And then last week, we had a financing announcement from Google and rumors that Meta may tap the equity market too. And it has to rotate out of something. On the flip side, however, there are forces pushing the other way. Anthropic just released its most capable model yet, Claude Fable 5, which should push demand for compute and tokens even higher. And the US government has signaled it could take stakes in some AI companies, which would put a floor under them. So on balance, I think we're fine here. Just stay selective and be careful with your entries if you are still building positions in the AI names. For the fuller picture on the outlook, go back and watch the last 2 episodes. Before I wrap up, the scoreboard. As discussed last time, this is the running tally of the calls we have made on this channel. The real names and tickers, equal weighted, winners and laggards together, no cherry picking. After the pullback this week, the AI and memory names have given some of it back. The equal weight work is up about 19% now, down from around 29 a week ago, which is exactly the rotation we just walked through. I'll keep this scoreboard running every episode so you can judge the calls for yourself. So, to pull it together, the jobs report was the trigger, not the story. The story is that the most crowded part of the market had a healthy flush. The money rotated rather than ran, and that is a reset, not a top. I stay constructive on the cycle and selective on the AI names into the summer. And I keep an eye on the calendar, the CPI print, the SpaceX debut, and the central bank meetings with the Warsh fast meeting at the Fed, the one that matters the most. That's it, guys. If you got something out of this, hit subscribe and like, and I see you next week.